Welcome back. You're watching the ET Money Show. And sometime last evening, you had the release of a circular by the Securities and Exchange Board of India. It is titled um, a circular on development of passive funds. And I must admit that quite a lot of it relates to the functioning of debt mutual funds, debt passive mutual funds, that is both ETFs and index funds. But there was one thing that I found very interesting, which was the possibility now of the emergence of passively managed equity linked savings schemes. This is the most popular product in the equity mutual fund space, and certainly a lot of promise is associated with that. Now we'll talk about everything that was included in that circular, both from the perspective of the AMC and most importantly from your perspective. Joining me to talk about it is Niranjan Avasthi, who is the head products, marketing and digital business at Edelweiss MF, as well as Mrin Agarwal, who is the founder director of FinSafe. Thank you so much to the both of you for joining in. Now, Niranjan, there was a very interesting conversation that you've already had on social media, and I thought that was quite enlightening. There was a spaces that I was listening to yesterday. Very quickly, for the benefit of our viewers, let's talk about the key announcements in this circular and how they change the functioning of both debt mutual fund passive schemes as well as equity schemes.
Sure. Thanks for having me. So broadly, it's a very good move by SEBI coming up with so many regulations and, very, very clear framework for passive funds, whether it is equity ETF or index funds or debt ETF or index fund. Some of the key announcements which were made, one is big on the equity ETF side, which is, creating the entire ecosystem, which includes, pushing a lot of investors onto exchange from the AMC platform. Then also incentivizing market makers, appointing minimum 2 market makers for each ETF. Also, there are some operational changes which are being done, which will improve the efficiency or the way market makers create or redeem units at the back end with the AMC. So all in all, this one major 2-3 changes are pointing towards a better liquidity for ETFs on the exchange in the medium term, because that is one thing which a lot of people were always worried about, why ETFs in India are not so liquid as compared to the Western world. So I think so some kind of a model which is not exactly same what is happening in the Western world, but somewhere near, where market makers have a very, very strong position when it comes to creating liquidity and creating and redeeming units, is being contemplated here. The second is on the debt side. Now we have seen last 2 years after the launch of Edelweiss Bharat Bond, a series of target maturity index funds being launched in India. The category is now almost more than 80,000-90,000 crore in just a matter of 2 years, with Bharat Bond ETF being almost the largest one. Over there also now there is a clear demarcation of 3 debt passive categories. One is pure corporate bond ETF/index funds like Bharat Bond. Then the second category of sovereign plus corporate bond index funds like PSU SDL series, which have been launched. And the last one is purely based on GSEC and SDL. And each of these 3 categories have their own rules in terms of security level exposure, group level exposure, sectoral exposure. So a lot of risk mitigants have been put in place now. So any innovation in this space, and I'm sure which will happen over the next 2-3 years, has a very clear roadmap and all these risk mitigants already built in, so that the product becomes much more pure and simpler for investors to understand. That is the second. And the third one, of course, there are a lot of other changes. One which you just mentioned is allowing ELSS scheme under the passive category. So AMCs who already have an ELSS may not be able to launch, because there is still a constraint that you can only have one ELSS scheme. But a lot of new age AMCs who are coming to launch ELSS now have an option to come and launch a ELSS in the passive space. So, and there is a demand, I think so some of these AMC would launch, and only time will say how investors pick them. So these are some of the 2-3 major changes Overall, I think so. It's a very welcome move, and paves a clear path for growth in passive funds.
To each of these concepts. Thanks for laying the roadmap for us and thanks for laying the context for us. Now, I want to focus on one aspect which you didn't mention, but I want to take this to Mrin first just to explain what these two things are. One of the very key mentions in that circular has to do with tracking error and tracking difference. When it comes to passive, this is a key metric to watch. So, first of all, Mrin, what is the difference between the two, and what was mentioned in the circular that should give investors something to think about?
Good evening, Alex. Nice to be on your show today. Well, difference between tracking error and tracking difference. So, tracking difference is the actual difference in performance of, or let's say the difference in the NAV and of your fund and the index, right? So, it's actually the difference, the actual difference in the performance. Whereas the tracking error really shows you how well the fund is tracking the benchmark. In a very technical term, it is actually the standard deviation of the difference in returns, basically. But essentially, when you look at the two terms, the tracking difference is really used to track the difference in performance, whereas the tracking error is used to track the consistency or the volatility in the performance of the index fund or the ETF versus the benchmark. So what the circular really says is that in case of equity funds, the tracking error needs to be less than 2%. And in case of debt funds, the tracking difference needs to be less than 1.25%.
I want to come to you, Niranjan, on this point. Is that percent something that is going to prove to be a challenge, or do you think that ETFs will be able to do this? Because one of the points that is going to be a bit of an issue is the point of liquidity, right? And if there is not enough liquidity on an ongoing basis, the impact of trades that are done will cause a difference to take place, right? The tracking difference to take place. So how challenging will this be for existing ETFs to manage?
So let's take one at a time. Let's talk about equity first. So equity, the tolerance level for tracking error has been set at 2%. Even today, most of the SIDs, if you see for ETFs on the equity side, have that clause where they aim to keep the tracking error within 2% band, and that's been for years. Now the only thing is it has come via regulation, so now AMCs will have to closely watch this number. If you look at the existing ETF baskets, so whether it is broad-based Nifty 50 based or even Nifty 500 or so, or the most popular Nifty Next 50 and Sensex ETFs and index fund, the tracking error over last many years have been much below 2%, honestly. So I don't see that as a challenge. It is only a tolerance level set so that, if you're launching new products, if you're launching something, maybe a small cap ETF or an index fund or some smart beta strategy where the underlying liquidity could be a challenge, or there could be operational issues like upper circuit or lower circuit in certain stocks. Now AMCs will have to be watchful before launching such products so that they don't, go beyond this 2% limit. Otherwise, I think so for broadly equity perspective, 2% is a good tolerance level, and I don't see existing ETFs, finding it difficult to, surpass that. On the debt side, instead of tracking error, tracking difference will be tracked, which is more meaningful because given the structural nature of debt markets in India, where the underlying is not liquid, at times there is huge bid and ask spread. I think so. Tracking difference makes more sense to instead of tracking error, and that is what SEBI has done. And over there also 1.25% limit on an annualized basis for last 1 year. I think so. It's a wide limit. While we don't have a large history of debt index funds in India today because it's been only 2 years, but I think so. Most of these debt index funds or ETFs will be, below that 1.25%. Because if you talk about debt, let's talk about 2030 Bharat Bond ETF, which gives you a YTM of around say 7.5% today. what the regulation is saying, if the index is 7.5%, the ETF, the portfolio will not go below 1.25% of the 7.55% or 7.5%. Now that is a huge gap. No debt fund will underperform the index over a 1 year period to that extent. And specifically when it's a target maturity fund, buy and hold. So I think so from tracking difference perspective also, the limits are well. I don't think so. At least the existing ETF structures which are there or index fund structures are there, will find it challenging.
Get both of your views on this next thing as well. Mrin, I'll come to you after I ask Niranjan this. Niranjan, there was a major announcement in that circular with regard to market making, which is absolutely crucial for exchange traded funds, right? It's the SEBI says that you need to have two market makers, and it is also stipulated the amount of a transaction that can be done directly with an AMC. It has set that limit at 25 crore rupees and above. Now, is that a very large amount? It is also stipulated, as I see it, and this is under the header of liquidity window for investors of ETFs with the AMCs, where it's given you a few instances where that can be overlooked, as I understand it. So, is this a good move according to you?
Yes, absolutely. As I earlier said, the aim of this circular on specifically what they've done on increasing the transaction limit to 25 crore, appointing market makers, making it compulsory to appoint two market makers, at the same time making operationally easy for market makers to, create redeem units without, having holding that inventory or taking that price risk. I think so. The entire circular around this is pointing towards to improving liquidity on the exchange. While we can say that 25 crore limit may be steep because currently the unit creation size is well below 1 crore for most of the ETFs, it could be steep, but I think so. The roadmap which SEBI wants to travel is follow what's happening in the Western world, where the secondary liquidity is, and the large chunk of that liquidity is in the secondary market, that is on the exchange. The second level liquidity is provided by the market makers and APs, and only if these two fail, then AMC comes into picture and gives liquidity to the investor. So they're trying to, get into this kind of model. It is just a start. I think so. Over a medium term, once each of these regulations get implemented, whether it is appointing two market makers, incentivizing market makers, or exchange also now being allowed to incentivize market makers for their activity, plus the settlement process and all. I think so. All in all, when everything comes together, it will definitely improve liquidity on the exchange. Because today it's kind of chicken and egg story where investors are not coming on exchange because there are no market makers, and market makers are not coming on exchange because there are no investors. So it has to be, one or the other way, where everyone is forced to go to the exchange.
Yeah, that's exactly what I want to ask Mrin about right now, because Mrin, I'm curious to understand, when you're advising your clients and they're thinking of looking at a passive strategy, uh, is liquidity one of the most important things that you talk about, and therefore do you say it's better to go for index funds as opposed to ETFs? What's the perspective that you have here?
Oh, absolutely. And I think, it's much easier to do the index fund. And also, when you are a long-term investor, yes, I do understand that there is going to be some difference in the expense ratio. Certainly, the ETFs are going to be cheaper than the index funds. But just looking at the liquidity situation, and, there are certain funds where, due to the fund size or various other factors, you're seeing a big difference in the NAVs that are quoted on the ETFs and the index fund, right? So, due to these reasons, typically we do recommend people to go in for index over the ETF. However, yes, I do think that all of these measures that are now being put into place hopefully will look at, increasing the liquidity levels and would get investors to come and trade on the exchange then.
I want to take one more point on the debt side, Niranjan, and I want to understand the construction of the portfolio for these passive debt funds. There are, and you referred to this, there are regulations now that state the exposure to a sector, an exposure to a group, an exposure to a particular entity. Is that going to be a challenge for existing schemes to manage, or is that already something that is being done by AMCs?
Yeah, a good point. So absolutely not a challenge for existing schemes, because if you look at the existing scheme basket, as I mentioned, out of 80,000, a large chunk, which is almost 60,000 crore, is the Bharat Bond, Edelweiss Bharat Bond ETF program, which is purely AAA PSU segment. Over there, if you ask me, there is no sectoral limit, there is no group limit, and the issuer limit is intact at 15%. So this regulation doesn't impact that portfolio at all, because the group exposure sectoral limit are not applied to AAA PSU segment, not applied to GSEC or ACLs. It is applied to AAA corporate bond segment. So Bharat bond set aside. The other part also, if you look at the funds which have been launched, mostly are PSU plus HTL. These are hybrid indices based on which the target maturity funds have been launched. Some 2-3 funds are purely based on GSEC. So today, if you ask me, there are hardly any ETFs or index fund which goes below AAA, and the limits are lower only below for credits below AAA, which is AA and single A. But at the same time, as I mentioned, it gives a clear path. So if someone wants to launch, someone wants to design, now there's clarity. There is already a risk mitigant in place, so that the exposure into these, AA or single A rated papers are already capped at certain level. But if you ask me, for existing fund, I don't think so anything changes. It already accommodates the existing ETF. There could be small tweak here or there, but no major changes.
Okay, I want to go to the point that I raised on the ELSS, because I think this is something that is going to interest a lot of people. Niranjan, I'll come to you shortly. But Mrin, one of the sticking points and one of the lacunae that have been pointed out is the expense ratio. And clearly this is something that is going to provide an opportunity for AMCs to cater to a very large audience through the passive route for ELSS. From a strategy point of view, and this is conjecture at this point because we don't know the kind of products that are going to be launched, 250 stocks is a wide basket to choose from, and so therefore the index is also, it'll be interesting what they choose. How should an investor contemplate their strategy using a passive ELSS?
Well, what I would say is that if you already have an existing ELSS that is performing well and that you've been investing in for many years, again, we'll have to see what's really coming out. Currently, if you look at most of the ELSs that are there that are actively managed, of course, the expense ratio is anywhere in the range of about 1.5 to, let's say, an average of 1.73%. So it is high expense ratio, but at the same time, the performance has also been good. And when you look at the various outperformance ratios, like for example, even if you look at the Sharpe ratio, all of these are positive at this point in time. So I think it will really depend on what really comes out. Certainly, the passive ETF is going to be much cheaper for investors as compared to the active ETFs, and one will really have to see what is the strategy that's going to be taken. Of course, it's top 250 stocks, and actually, even if you look currently right now, most ELSs have about 60% in large cap stocks and maybe about 20% in mid cap. So I think it's really going to then boil down to maybe a difference in the cost, and we'll have to wait and watch.
I think you're the best place to talk to about this because you're handling products and you're somebody who will be able to comment on this, I guess. What is the possibility of active funds making a transition to passive? Is that at all something that AMCs will consider doing?
I don't think so, because if you see most of the AMCs, ELSS funds are one of their flagship funds being run for almost decades or more than that. These funds' performance have been really good. As Mrin mentioned, most of these funds, they have positive alpha, positive Sharpe ratio over a longer period of time. Most of these have run as a multi-cap fund. Some may be tilted towards large cap to some extent, but end of the day, they are multi-cap funds, flexi-cap funds kind of mandate, where alpha generation opportunity is still there. So I really don't think the existing active funds will be, changed to passive funds. But I definitely see some newer AMCs who have not yet launched maybe active ELSS scheme may take this route and offer passive funds in the ELSS category very soon.
I think we've had a very comprehensive conversation, and I'd like to thank both of you for the perspective that you've brought to this program.
Thank you so much for having me.
All right, now we have to slip into a very short break, but there is more on the other side, so do stay tuned.